Welcome to my SIPP portfolio update. I started this account around 3 months ago, and with plenty happening in the market since then, I thought this was a good time to review how it's performed, have a look at some of the news that's impacted it, and highlight some areas you may find useful for your own portfolio. This is the portfolio I currently hold on Hargreaves Lansdown. Now, I know it's not the cheapest of platforms, but it was just the most convenient all-in-one platform where I could combine some old workplace pensions together. It does everything, so I can hold ETFs, I can hold shares in multiple different countries. The fees are not too bad, it's 0.45%, but it's capped at £200 per year. So anything over 44,000 in your portfolio, your actual percentage starts to reduce. I've got around 61% of the portfolio in ETFs split across 6 different funds, and then 39% split equally across 6 different stocks, around 6 to 7% in each individual holding. This is a very bold approach, but being a SIPP, it's a long-term product. I'm 35, so I know I've got at least 20 years before I can access this. I know it's going to be a very bumpy ride, it's going to be very volatile. I can afford to ride out that volatility because I've got the time horizon. The ETFs are all passive, where I'm simply just trying to capture the market performance, and then the individual stocks are obviously more active plays where I'm trying to get a superior return. I could have kept it really simple with the ETFs and just picked one global ETF. That would have been the most simple and hands-off approach. But of course, being me, I wanted to put my own spin on it. So I've essentially created my own DIY global portfolio. I did this for 2 main reasons. The US has been on an absolute tear in recent years, and I do feel it's slightly overvalued. That doesn't mean it's suddenly going to have a massive crash like everyone seems to be predicting. But I do want to slightly underweight the US moving forward. In a normal global ETF, they make up about 60% of the fund, and that just highlights how much the US has dominated in recent years. But I want to move some of that weight towards areas like emerging markets, so places like China and India, and also in the UK as well, which I feel has slightly been lagging and slightly undervalued. With the stocks, I try to keep it fairly simple. I use a top-down approach, and I use 3 different themes: defense, AI, and nuclear. Defense stocks have performed really well in recent years, especially since Russia's invasion of Ukraine and numerous other conflicts all around the world, including Israel and Iran, and more recently the US operation in Venezuela. I don't see the conflicts dying down anytime soon. With AI, it's been all the talk in the last couple of years, and more recently everyone's talking about an AI bubble. And I think the likes of Nvidia and Microsoft have still got some runway to go, but they're such big companies now. I wanted to focus on AI companies that focus more on the AI infrastructure, a more picks and shovels play. So I focused on areas that support AI rather than the direct AI narrative itself. And then nuclear. This was more aimed at energy production rather than nuclear weapons. And this slightly overlaps with the AI narrative because of the amount of energy that these data centers need, but also in a drive to create more cleaner forms of energy. And so I feel nuclear is going to have a massive role in the next 10 years. The 2 defense stocks I've got are BAE Systems and RTX. And their performance in the last 3 months is so different despite being in the same industry. But I don't think this tells the whole story. My holding in BAE is actually my only negative stock. And part of the reason for this is actually just not getting in at a very good time. I got in about mid-October, start to mid-October. And BAE in the last year has been on an absolute tear. So I got in up here, and it's had all this performance already. So granted, it's not the best time to get in. And then from there, it actually fell around 20% before it started to recover in recent weeks. And part of this, I think, is people just trimming positions. They're taking profit off the table, especially with such a big run over the last 2 or 3 years. But also, I think this is very volatile stock, and it's very reliant on news and media. So when we've got peace agreements being proposed, especially for like Russia and Ukraine, and there's been many of these, but this is definitely a stock that when a peace agreement it feels like it's close to coming into fruition, BE would tend to have a negative movement. And it was around the end of October, November when these peace plans were drawn up, and that just added fuel to the people already taking profit. And they saw some positivity, which on a global sense is positive, obviously, looking for peace. But from a defensive stock point of view, it's negative, especially as it's had such a big run up. As we've seen many of times with these agreements between Ukraine and Russia and the US getting involved, they don't tend to materialize. And hence these have now started to reverse. And then to add fuel onto the fire, we've now seen more US involvement, especially in Venezuela. And hence over the last few weeks, we've started to see BAE Systems really start to rally again. So actually from where I bought it, it's not far off, but it has come down 20% before recovering. RTX, on the other hand, is just moving in one direction. It's still been fairly volatile, but just look at the growth it's had over the last couple of years. And one of the key differences between RTX and BAE is simply where they're based. RTX is American and BAE is British and more aimed at the European theatre. And it's the Russia-Ukraine conflict that has mainly been the big driver behind BAE. The Europeans have had to massively increase their defense budgets. They're fearing that the US is not going to support them as much as they may have expected, and they're having to put much more money into their defense budgets, and BAE are benefiting from that. But any peace agreements or anything that gets closer to that conflict coming to an end, that's then going to be a negative weight on companies like BAE. But with companies like RTX, being American, they're still going to have downward drivers if certain conflicts get resolved. But because the US war machine is so big, the military spend is just insane, and they're involved in conflicts all around the world, there's less of a downward impact on RTX. And then my AI plays, I've got ASML, which were involved in the manufacture of the AI chips themselves. And then I've got Equinix, which is involved in the real estate of data centers. ASML has been my best performer at 16% in 3 months. I actually had quite a negative first half of 2025 and the end of 2024. And I think this was partly the AI narrative just getting a little bit overinflated. The run up to mid 2024 was then also the likes of the big tech firms were also rallying with the AI boom. And I think sometimes when these things move so quickly, they get a little bit ahead of themselves. And hence we then had quite a bit of a rundown into 2025. Added to this, we also had the tariff crash in March and April of last year. But since then, it's actually recovered really well. And in recent weeks, it's hit a new all-time high. Equinix, on the other hand, has been almost flat. And being a real estate investment trust, this is very dependent on the deals that it makes. And this has got a great runway. It's definitely got a lot of potential in the long term. But in recent months, it's had two main headwinds: the delay of some major deals and also some FX impacts. And this is a key theme that we've seen across a number of different holdings in this portfolio. And because the pound has appreciated against the dollar, predominantly in 2025, holdings like Equinix, which are US based, are going to see a negative impact when you look at it from a British pound perspective. That's also why my ETF holding here in North America is negative, despite the S&P 500 being near all-time highs. And in the long run, FX impacts shouldn't really be something to be concerned with. They tend to even out, especially over a long period of time. But in the short term, they do explain some of these movements. And then my two nuclear stocks are Cameco and Rolls-Royce. Cameco are mainly involved in the mining of uranium, the key material needed for nuclear reactors. And then Rolls-Royce is an interesting one because it's got what I would call a trifecta exposure, because it makes jet engines for both commercial airliners and the military. And now more recently, it's getting into nuclear reactors with its SMR technology. And the UK government actually recently announced that Rolls-Royce are going to be their preferred SMR technology provider. SMRs are small modular reactors, and they can be built much quicker. They can be built on site and therefore much more scalable. I did get quite lucky with Cameco because they also have a stake in a company called Westinghouse. And at the end of October, the US government announced a partnership with Westinghouse of around $80 billion for new nuclear reactors in the US using Westinghouse reactor technology. And that was the cause of this jump here. It then did retrace a little bit, but it's now recovered and it's still on the way up. With Rolls-Royce, the performance has just been insane over the last few years, and I got into this way too late. But I still do think they've got a really long runway, especially because of that trifecta exposure. And I think they did suffer a very similar fate to BAE with the peace agreements in November. But since then, they have recovered from that. And again, it started to rally. So I haven't really got any concerns with the stocks that I hold. I just have to accept they are going to be volatile. But the beauty of being a SIPP, although I can make changes, I can't access the money, so it's not like I can sell it if I need it for something else. So I may as well just hold it in these individual stocks and just let them do their thing. I've also got dividends being reinvested, so they'll just tick over it in the background, buying me more shares as they pay out. Moving on to the ETFs, and the main theme here was to have that global ETF approach, but to be able to choose my own weightings, predominantly because I wanted to reduce my US exposure. You can do this in a number of different ways, but I find using these 6 ETFs, which cover different regions, allows you enough control, but it's not too many that it gets too confusing and too hard to manage. Typically in a global ETF, North America makes up about 65% of the fund, and I've reduced that by about half and then spread that across some of the other regions. And my best performer has been developed Asia Pacific, excluding Japan, which has done 11.5% in 3 months. And that's mainly been all Korea. Something to note with FTSE funds, that Korea is counted as a developed nation, where with MSCI, it's still classed as an emerging market. But in the developed Asia Pacific fund, the main players are Australia, South Korea, Hong Kong, and Singapore. But the main reason for growth in the last few months is another AI play, both from South Korea, and they're actually the 2 biggest holdings in the fund, Samsung and a company called SK Hynix. A lot of the focus and hype around AI has been with the GPUs that Nvidia are making, but the chips that Samsung and SK make are more designed around storage and memory. And while all these chips are needed for AI moving forward, I think this is what creates such big waves and big cycles, because there's different demand at different times for different types and styles of chips. And then other notable mentions, I'm pretty happy with the UK and the European ETFs. They have got some similarities in performance, the main drivers being banks, pharma, and defense. And there is also some overlap with some of the individual holdings I've got. So ASML is quite a big weight in the European fund, and Rolls-Royce is fairly high up in the FTSE 100. The North America one is an interesting one because it's still my biggest holding despite me reducing exposure. And I think that's the key difference. When we talk about reducing exposure for a specific area, it's not saying that we think it's going to perform badly or perform negatively. It's just that I feel there's performance to be had elsewhere. And if I followed a normal global ETF, that exposure would be double what it is now. And it's only been 3 months, so you can't really read into it too much, but it's worked out nicely so far. And the US stocks haven't performed negatively. They are up. It's just had that downward pressure from the FX impact. So overall, I've got to be happy with the portfolio. In 3 months, I'm up just over 4%. And I think I could have looked at a lot of these individual holdings, and I got in at a pretty bad time. I got in quite near the top. A lot of them saw retracements soon after I invested. So it definitely wasn't the best time to invest. And I'm still up over 4%, so I've got to be happy with that. But the key with these types of portfolios, especially with SIPs, is not to look into it too often. I think quarterly is absolutely fine just to review it, but it's not something you want to be checking prices every day. And especially with the news at the minute, it just feels like something new is happening every day. It's so easy to get too involved with it, and I think that's just not good for your mental health. A key area where I see people struggle is knowing the right time to sell an investment. I break it down in this video, so watch this next.